with the new legislative changes beginning July 4th of this year, we have some changes that affect estate planning. The real question is, what should we be doing? What should we be telling our clients? Do we stick with the old techniques, the traditional techniques? Is there something else? Is there a new focus that we need to be considering? First and foremost, under OBBBA, the estate, gift, and GST, which is the generation skipping transfer tax exemption, are permanently raised to $15 million per individual, which is $30 million per married couple, and that number is going to be indexed for inflation. Currently, for any estates that may still trigger in 2025, the exemption is $13.99 million. There's already, as a result of the Tax Cuts and Jobs Act, there was already a decrease in the number of estates that were affected by the federal estate tax and the GST. Under OBBBA, that number is going to be even fewer, but it still remains. The top 40% tax rate remains intact. That has not changed. Portability. This is a federal concept that allows a surviving spouse to transfer over a predeceased spouse's unused exemption, still remains intact. And the step up in basis, that concept, where you get an adjustment to cost basis on assets valued as of date of death, that is also remaining. There are some other lesser known provisions that have changed. Trust and estates lose their miscellaneous itemized deductions. I talked about that from the individual perspective earlier. It affects trust and estates as well. So the planning landscape is altered to some degree, not dramatically, in some instances, fairly significantly. Let's talk about estate planning for spouses. Three things to consider here. First is the unlimited marital deduction. This is basically an amount that spouses can transfer to one another both during their lifetime or upon death through their estates, which allow for the transfers to remain gift and estate tax free. So that remains unchanged and it remains a pillar as part of our estate planning strategies. Second, portability. I mentioned before, this remains a very powerful tool. So when the first spouse dies, any unused portion of that spouse's federal exclusion can be ported over. This is referred to as the DSUE, D-S-U-E, the deceased spouse's unused exemption amount. Okay. Third, and this is one of these big gotcha moments, the executor of the first deceased spouse's estate must timely file a Form 706, that's the federal estate tax return, in order to elect portability. Now, the time frame has increased, I think, 5 years now, to file a return simply for portability purposes. And an estate tax return, federal estate tax return is due 9 months after death. The tax is due 9 months after death on any amount over the exemption, okay? If you have an estate that is below the exemption amount, traditionally, you didn't need to file an estate tax return. However, if we're going to elect portability, and it is always advisable to do that because you don't know what the surviving spouse's assets are going to become when they pass, it's a good idea to elect portability to transfer over any unused exemption from the first deceased spouse over to the surviving spouse so that they have additional exemptions that they can apply either as part of their lifetime estate planning or through their estate when they die. But it's important that the election be made timely and to be made accurately. We've seen this there's a case in the state of Roland versus Commissioner, sloppy filing using incorrect or not well valued assets. The IRS is not going to accept the return as filed and not going to accept the election. Portability will not happen. Okay? Formula clauses, we're still using those. Traditionally, many married couples will say, I leave to my spouse the largest amount that can pass federal estate tax free or estate tax free, whether it be federal or state. and have those assets that are directed there fall into what's called a bypass trust or a credit shelter trust or the AB trust scenario. These plans rely on the formula with the OBBBA increase in the exclusion of $15 million, and with uncertainty about state rules, all formula clauses may misfund the trusts or leave rollover opportunities on the table. It's important that as advisors, we review those trusts, we review those wills to make sure that the way that the formula clause is currently read serves the client's purposes based on their asset values, based on their state of residency. It's important that we review these now so that going forward, we have documents that do what they're supposed to do from the most tax optimization purpose. In the end though, formula clauses still are functional. They should still be used, but they need to be tailored to the client's needs. One of the conversations that I had today, do trusts still make sense? And if so, what type? The answer, I think across the board at this table here will say yes, trusts still do make sense. Estate planning is not really about tax optimization. That is a key consideration, especially for our high net worth and ultra high net worth clients. However, trusts still do make sense for other purposes. They provide control, flexibility, protection. When I say protection, I'm talking asset protection, creditor protection, divorce protection, and planning for other non-tax risks, okay? For higher net worth clients, they do remain highly relevant for estate and income tax planning. Given the OBBBA legislation, we may need to shift our focus from the must use purely to avoid estate tax trusts to the use trust to manage wealth, growth, basis, family governance, estate tax issues, shift appreciation outside of the estate, using trust for estate freeze techniques. Marty discussed the idea of stacking under 1202, using non-grantor trust for that purposes, using non-grantor trust to stack to gain the benefit of the $40,000 SALT deductions, using non-grantor trust for purposes of avoiding income tax for those states that are large income tax states in the form of ING-trust, incomplete gift non-grantor trusts. These trusts still do apply and are very part of our estate planning strategies. So what type of trust makes sense? Talked about the slats, and as much as I hate to use the term potentially defective non-grantor trusts, they are grantor trusts. They are still very widely used and effective tools for lifetime gifting. Estate freeze techniques, sales to grantor trusts to allow for the appreciation of assets to occur outside of an estate. Spousal lifetime access trust or SLATs are still useful for married couples and can be triggered to be marital deduction trusts. GRATs, for those clients who have assets that they know are going to appreciate significantly, especially in the short term, the use of grant to retain annuity trusts are a huge boon for those clients. Dynasty trusts for intergenerational, multi-generational planning are extremely powerful. And as I just mentioned, the non-grantor trusts are also extremely powerful for stacking 1202 strategies, as well as using them for avoiding income tax when there's a liquidity event. So remember that the basis rules under OBBBA have remained unchanged. Step up at death still is in place, and this is one very important benefit of a death transfer, namely that the built-in gain is wiped out for income tax purposes upon death. Even with the higher exemption, consider this. This is what we were talking about before. There may be a trade-off for your clients. Is it more important to use trusts to get assets out of the estate, to have the assets grow outside the estate tax free? Or from a tax perspective, is it more advantageous for clients to die owning the asset because they do get the step up in basis? Okay? Gifts that occur outside, gifts that occur before death don't generally get that step up in basis because there's a carryover basis into the trust or direct gifts to individuals. So there may be some trade-off and some of the analysis that needs to be undertaken before any transfers are made to determine what is the best scenario for the client. I know we've talked about the use of non-grantor trusts, but this is really where, under OBBBA, the use of trusts has gone beyond just looking at estate taxation as the driving motivation for the use of trusts. The law increased SALT deductions to $40,000 cap per itemizer. Use non-grantor trusts for that purpose. For clients in high tax states, using these trusts opens the possibility of stacking multiple trusts for 1202 purposes for small business stock. They are complex trusts, and they need to be carefully drafted because the slightest misdrafting can cause what is intended to be a non-grantor trust to be treated as a grantor trust, and the benefit of the non-grantor trust status will be lost. Let's talk about the use of general powers of appointment. For the non-estate planners in the room, a power of appointment is a power that's given to a beneficiary of a trust to allow them to disproportionately change the allocation or the default allocation that's established inside of a trust. A general power of appointment is a power that is given to a beneficiary that allows the beneficiary to appoint the assets in the trust to themselves or anybody else. It allows them to appoint to their creditors, their estate, or the creditors of their estate. This causes the assets in the trust to be included in the beneficiary's estate. And there are particular reasons that it might be beneficial under OBBBA to use general powers of appointment. Both before OBBBA and after, it's still a very widely used and important technique because what it does is essentially allows the beneficiaries who otherwise would not have the assets included in their estate. It allows them to include the assets in the trust in their estate and apply their own estate and generation skipping transfer tax exemption to those assets. It's a second dip at the apple that they may not otherwise have had. So if mom or dad or grandma or grandpa have created these large trusts or intending to create these large trusts with significant appreciation, significant value, leaving the estates of their descendants more modest so that they're not taxable, it might be worth taking a second bite to have some of these assets. Let me say this again. It might be worthwhile to allow the beneficiaries to use a general power of appointment to treat the assets as being included in their estate so they get a second allocation of assets, especially if the trusts themselves have both generation skipping transfer tax exempt assets and non-exempt assets. Those non-exempt assets, allowing the beneficiary to treat those assets as being included in their estate, is a tremendous benefit going forward. Let me just move forward. So considerations for ultra high net worth and high net worth clients. Many of these clients still exceed the federal exemption. They might have significant exposure to state estate taxes as well. For them, lifetime gifting into trusts, grantor trust, dynasty trust, GRATs, using trust for business succession planning and valuation discount planning are still a front and center estate planning technique. Those should not be changed. Clients that have non-taxed drivers, in other words, protecting family business issues, international exposure, litigation, and credit risk, trusts are highly useful for those clients as well. So, okay. Let's talk here for advisors and for your clients. Let's just sort of run through a checklist of some of the things that we want to look at for them. Review all existing estate planning documents, especially under OBBBA. Consider the right timing for gifting. Higher exclusions now are going to be even higher next year. It might be worthwhile to wait until 2026. Reassess funding of bypass trusts. Use of formula clauses in the documents. Previously, first step funding was almost automatic. It may not necessarily be automatic at this point. There may be reasons to choose a simpler route. Clients who don't have the necessary level of wealth, it may be more cost advantageous and better for them to simplify their estate plans. Don't leave it so complex. It doesn't have to be anymore. For trust structures, do a cost-benefit analysis. Evaluate, in light of the new legislation, whether it makes sense to create these irrevocable trusts, the complex planning. Consider stacking using non-grantor trusts as an alternative to the grantor trust structure, which is really what we've always kind of looked at in the past. I'll take any questions.